Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about China Communications Services Corporation Limited Annual Report. China Communications Services Corporation Limited offers a wide range of businesses and services to its global clients. At the core of its operations are telecommunications infrastructure services, which include planning, design, construction, and project supervision for various networks such as fixed line, mobile, broadband, data centers, and supporting systems. The company also provides business process outsourcing services that encompass network maintenance and optimization, general facilities management, supply chain services, and repair and disposition. These services cater to the needs of domestic telecommunications operators, government, and enterprise customers. In addition to these core services, China Communications Services Corporation Limited offers applications, content, and other services such as system integration, software development, and value-added services. The company is also involved in submarine cable installation and related services, distribution of communication and information products, terminal sales, device distribution services, and procurement services for IT devices and equipment. Furthermore, the company provides integrated solutions for informatization, digitalization, and intelligentization, which are essential for modern businesses to stay competitive in today's technology-driven world. With its extensive range of services and expertise, China Communications Services Corporation Limited has established itself as a leading provider of telecommunications support services globally. China Communications Services Corporation Limited maintains a market capitalization of $29 billion, broadly in line with the industry peer group. China Communications Services Corporation Limited trades at a lower price-to-earnings ratio of 7 times and a lower price-to-book ratio of 0.56 times relative within the industry. This makes the stock appear attractively priced. However, the broader industry is also trading at low valuation levels, suggesting sector-wide pessimism rather than the company-specific undervaluation. Further evaluation is required to identify if the company worthy of investment, or could it be an extended period of low valuation or a value trap. The leverage on the balance sheet appears elevated, with liabilities of 66% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 5.69%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth or decline can be identified through a thorough analysis of various market trends and customer behaviors. On the growth side, domestic non-operator markets have shown a significant increase of 5.5% year-on-year, driven by AI-driven intelligent computing and data center construction, urban renewal, and green transformation. Digital infrastructure has also witnessed a remarkable 40% year-on-year growth in new contracts, while strategic emerging businesses have seen a 21.7% year-on-year increase in total value of new contracts. Furthermore, business process outsourcing, BPO, services and applications, content, and other ACO services have shown moderate growth rates of 1.4% and 0.9%, respectively. The software development and system support business has also experienced double-digit growth. On the other hand, revenue decline is attributed to cautious investment by customers, intensifying market competition, and decreased demand for certain services such as telecommunications infrastructure, TIS, and domestic telecommunications operators market. The decline in revenues from CTC Group and products distribution business have also contributed to the overall decrease in revenue. It is essential for businesses to identify these trends and adapt their strategies accordingly to stay competitive in the market. The net income of a company has experienced a slight increase of 0.1% on a year-over-year basis. This marginal growth is notable, but it does not necessarily indicate a significant improvement in overall financial performance. A closer examination reveals that the gross profit margin has actually decreased by 0.4 percentage points over the same period. This decline suggests that while revenue may be increasing, costs are also rising at a faster rate, thereby eroding profitability. Notably, despite these fluctuations, the net profit margin has remained relatively stable over the past 4 years. This stability is a testament to the company's ability to manage its expenses and maintain a consistent level of profitability, even in the face of changing market conditions. The company's financial performance is a notable aspect of its overall success. One key indicator of this is the generation of positive operating cash flow, which has been consistently demonstrated in recent years. According to the provided information, the company generated a significant amount of free cash flow, totaling RMB 795 million. This suggests that the company is able to generate sufficient cash from its operations to cover its expenses and invest in growth initiatives. Furthermore, the data on operating cash flow confirms this positive trend. In 2025, the net cash generated from operating activities was a substantial RMB 938 million, indicating a strong ability to produce cash from core business operations. This is reinforced by the explicit statement that the company has achieved positive operating cash flow, as noted in the summary. In conclusion, the evidence clearly indicates that the company is generating positive operating cash flow, which is a crucial indicator of its financial health and stability. The company's financial health has shown significant improvement in terms of debt levels and interest expenses. The total liabilities have decreased by a substantial amount of RMB 12,410 million, indicating a reduction in the company's overall debt burden. This is further supported by the decrease in indebtedness by RMB 7 million. Moreover, the interest-bearing borrowings remained constant at RMB 699,358 million, suggesting that the company has managed to maintain its borrowing capacity without any significant increase or decrease. The finance costs have also seen a notable decline of 18% or RMB 18,679, indicating a reduction in the company's interest expenses. Overall, these changes suggest that the company has made efforts to manage its debt levels and reduce its interest expenses, which is a positive sign for its financial health. Management is emphasizing the importance of technological innovation in driving new productive forces, positioning the company to maintain its market-leading position in domestic telecommunications operator customers. To achieve this, the company plans to integrate itself into customers' ecosystems and enhance product and service capabilities. In addition to maintaining its domestic market share, management is also looking to expand into non-operator markets and overseas markets as part of the Digital China strategy. This expansion will be driven by investments in key areas such as AI, digital infrastructure, and related fields. To support these growth initiatives, the company is focusing on improving cash cycle management, reducing financing costs through currency diversification, and increasing investment efficiency. By controlling non-operational investments and strengthening accounts receivable and payable management, the company aims to optimize its financial performance and create a solid foundation for future growth. The company has a history of paying dividends to its shareholders. In fact, it has been consistently paying dividends over the years, with a proposed final dividend for 2025 amounting to RMB 0.2241 per share. The company's commitment to rewarding its investors is evident in its decision to pay out a significant sum of RMB 514,720,000 as final dividend in 2025. On the other hand, the company has not engaged in share buybacks. This suggests that it prefers to allocate its resources towards paying dividends and reinvesting in the business rather than repurchasing existing shares. Concerns about the supply chain have been raised due to recent developments. Specifically, there has been a notable increase in subcontracting charges, with a 1.1% rise in 2025. Additionally, materials costs have also seen an uptick, increasing by 3.3% in the same year. These changes may indicate potential disruptions to the supply chain, but there is no indication of inventory buildup being a concern at this time. That concludes the financial summary for China Communications Services Corporation Limited. Feel free to comment below, and I will be happy to answer them when possible.